Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. Hello, CMQ investors. Welcome to the show. Let's jump right in. Warren Buffett's letters to Berkshire Hathaway shareholders are a rich source of investing wisdom. I say this to remind you, and also to remind myself, to keep reading them. There's zero downside. In the 1996 letter, Buffett offered an important piece of advice, and I quote, "Investors making purchases in an overheated market need to recognize that it may often take an extended period for the value of even an outstanding company to catch up with the price they paid." These words are as relevant today as they were in 1996. Now, I wasn't investing in 1996, let alone even paying attention to the stock market. So I wanted to go back in time and make sure I knew exactly what Warren Buffett meant when he said overheated market. What I found could be an episode in itself. Fortune magazine published an article titled, "Is the Stock Market Too Pricey?" It appeared in April of 1996. As I read a few paragraphs from that article, ask yourself if it sounds like April 2021. What I'm about to read was written by Richard D. Hilton. There's nothing like a scary stock market drop to get investors wondering whether the market is too high. Fueling that year-long rise has been a flood of cash from individuals. In January alone, small investors poured $29 billion of household assets into stock mutual funds, which is about 57% more than the previous one-month record of $18.4 billion. February's inflows look as if they'll also be off the charts. All but drowned out by the roar of billions of dollars pouring into the market are a few faint voices warning that the good times can't last. Says Robert Farrell, Merrill Lynch's senior investment advisor and a student of stock market cycles for nearly 40 years, quote, "I'm worried that people have gotten too optimistic about stocks. Every market tends to be met with skepticism most of the way up, but there comes a point when the fear of risk is overtaken by the fear of missing out. That's when people get carried away and the money starts pouring in. The billion-dollar question, then, is will the euphoric highs be obliterated by a nasty back-to-reality crash? And if so, when?" The frightening market swings in early March suggest that stocks are vulnerable, but more reliable indicators are to be found in the classic barometers, price-to-book value ratios and dividend yields, that Wall Street uses to gauge whether stock valuations have gone off the deep end. These indicators all point to the same alarming trend. Prices do seem to be getting out of hand. The price-to-book value ratio on the S&P, now about 3.5, is miles above its historical average of 1.8 and the highest it's been for at least 30 years. Dividend yields, which have averaged about 4.3% over the past 70 years, now languish at a paltry 2.2%. That anemic level is below even the scary depths dividend yields reached before the 1929, 1972, and 1987 market drops. In fact, it is the lowest it has been since 1926. Other valuation measures, like price to sales or the ratio of stock market value to GDP, also appear overextended. So what does it all mean? Worriers like Farrell explain that markets often stay overvalued for long stretches of time before they come careening back to justifiable price levels, but eventually they always do. Regression to the mean is what the markets are all about, says Farrell. I will include a link to read this entire article in the thread for the episode of this podcast. You can find that on our newsletter, cmqinvesting.substack.com. Sign up for free and be notified every time we release new content, including these podcasts. Let's go back to what Warren Buffett said, now that we have this context about 1996. The lesson is, even if a business is great, it's not a great investment if you pay too much for it. Let me say that a different way. It's great to own a piece of a great business, but if you pay too much, it's not a great investment. And this is something that I think is easy to lose sight of in a market where people believe that stocks only go up. A company's stock price will eventually reflect the operating earnings of the business. The investing legends that I reference in our episodes all share that same view. Peter Lynch put it this way: "I don't think people understand. There's a 100% correlation with what happens to the company's earnings over several years and what happens to the company's stock. Robert Hagstrom used a laboratory group of 1,200 companies to determine how closely price and earnings are connected. In doing so, Hagstrom discovered that the longer an investor holds a stock, the more significant the relationship is between price and earnings. It's wonderful to find a wonderful business. Just don't forget this truth. An investor who pays a premium price and an investor who pays a fair price end up with wildly different results over a long time period. That's the nature of compound interest. Chuck Akre is the founder of Akre Capital Management. Akre once said that the reason price matters so much is because, quote, the starting price has everything to do with your compound returns. Think about those investors who bought Viacom CBS when it was nearly $100 per share. If they hold on for the long haul and Viacom CBS is successful, they'll do fine. But I paid $28 for my shares in August. They paid $100. If we hold for 20 years, the time I spent valuing the business before I determined if it was worth buying at the current price will have been time extremely well spent. Albert Einstein told us that compound interest is the most powerful force in the entire universe. Use it to your advantage. These little things you do that seem tedious or unnecessary or just boring, well, they can make an enormous difference. Speaking of doing little things that seem boring that can make an enormous difference, I want to conclude with a fun fact that came about totally organically in the research process. I was reading about 1996, and somehow that led me to discover Chuck Akre, and I was reading about him. And I discovered that Chuck Akre has credited reading Warren Buffett's writing with having the most significant impact on his approach to investing. The best investors never stop learning. That's 100% fact. Creating these episodes is a key part of my own learning process. And something I'm committed to doing is delivering like I'm delivering pizza. It's to create more content, to give you more value more often, more consistently. That's the plan moving forward. My process is to figure out the big ideas that really work, understand why they work, and that's so important, understanding why, and then seeing if I can make it work for me. And if it does, then I share it with you. That's what CMQ investing is all about. I'm excited for what's to come. I hope you learned something from this episode. Make sure you sign up at cmqinvesting.substack.com. We have a paid subscription. Our paid subscribers receive more content related to these episodes and much, much more. I have no doubt that soon enough we'll have guests. We'll be doing all sorts of different types of content. It's important that we experiment, we try different things. But at the core of everything we do is we want to make all of us collectively wiser about investing. And that's something worth being. Charlie Munger says the best thing a human being can do is help another human being know more. If you learned something from this episode, please share with a friend or someone else who you think would benefit from knowing. Feel free to send me a tweet at Chris Franco. Follow at Charlie Munger Quotes on Instagram. Make sure you subscribe if you're listening on Apple Podcasts or Spotify. Leave a review. Just like what we talked about earlier, those are all little things that go a long way and make a big impact on the ability for this show and the wisdom that we're trying to get across, reaching the people that will benefit from it most. Now, on that note, my name is Chris Franco. This is Compound Money Quietly, the CMQ Investing Podcast. Thank you again for listening, and we'll talk to you soon.